Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday the 13th of May 2020. And yesterday we published a video entitled More Stimulus Ahead, Banks Running Out of Options. And on Monday, the reasons advisors are now recommending gold as an investment, where we highlighted that central banks will do whatever is necessary and will pump in as much liquidity into the system that it can, while at the same time investment advisors are now recommending gold as an integral part of an investor's overall portfolio. Well, today we shall continue slightly with that theme by quoting a Bloomberg article published less than half an hour ago. Bloomberg article dated May 13th, 2020, 5:40 p.m. GMT +1. Headlines: Stocks slide deepens on Powell, US, China worries. Markets wrap. US stocks tumbled to a 3-week low after Jerome Powell warned economic risks from the virus are significant and tensions with China flared. The S&P 500 fell after the Federal Reserve Chairman said the threat of a lasting downturn can deepen without additional government spending. Equities extended losses after a federal savings plan delayed moving funds into an index with Chinese stocks, adding to tensions stoked by President Donald Trump. The stock weakness has the S&P 500 headed for its worst week since March 20th, the session before a furious 30% rally started. Equities tumbled Tuesday after health official Anthony Fauci warned the pandemic could worsen if states open too soon, and some Fed chiefs expressed concern the recession will be long. Famed investor Stanley Druckenmiller also hit sentiment, saying stocks are too high. David Tepper joined hate chorus Wednesday, saying only 1999 was more overvalued than the current stock market. Meanwhile, traders of Fed funds futures pushed bets on a negative policy rate into next year after Powell's comments. He acknowledged the speculation but said such a move was not being considered, though he stopped short of completely ruling the tool out as an option in the future. While Powell's remarks paint a grim but realistic picture of the deep scarring of the virus on the US economy, Fed watchers might find relief in the fact that Powell remains committed to deploy his remaining arsenal to the fullest extent as we continue to ride out the pandemic, said Mike Löwengart, Managing Director of Investment Strategy at E-Trade Financial. This means their toolkit primarily relies on additional fiscal stimulus. End of article. The article shows that the Fed will do whatever is necessary, but the pain suffered may now become even worse as relations with China becomes more and more tense. This is going to have an inevitable downward impact on equity markets. So much so that at the time of writing, the Dow Jones is down nearly 500 points or 2% at 23,267. The S&P 500 is down 48 points or 1.7% at 2,821. And the Nasdaq is down 188 points at 8,813 points, down 2.1%. British and European markets have fared no better and now currently closed. The Euro Stoxx 50 closed down 2.5%. The FTSE 100 index down 1.5%. The DAX index down 2.5%. And the CAC 40 down 2.85%. Now, an article just published by Reuters a few minutes ago reveals what has happened with UK markets in particular. Reuters article, dated May 13th, 2020, originally written at 8:16 a.m. but updated 8 minutes ago, which is 1800 hours GMT +1. London stocks drop as economy shrinks at record pace in March. UK stocks fell on Wednesday after data showed the economy contracted in March at a pace never seen before as the coronavirus crisis escalated, while analysts warned of more pain ahead. The blue-chip FTSE 100 index shed 1.5%, snapping a 5-day winning streak and wiping out most of the gains it made this month on hopes that an easing in restrictions would revive business activity. Britain's economy shrank by a record 5.8% in March, while first quarter GDP contracted by 2%, with figures for April likely to show an even bigger fall in economic output. The Bank of England has predicted the biggest economic slump in 300 years. Second quarter figures that cover a much longer period of lockdown will obviously be far worse, said Hugh Gimber, global market strategist at JP Morgan Asset Management. While economic activity should improve from the second half of this year, it still appears that a rebound is likely to be very gradual. The mid-cap FTSE 250 also shed 1.8%, with travel stocks plummeting again after a warning from European travel company TUI about thousands of job cuts to ride out a virtual halt in global travel. The retail index dipped 1.4% after surveys showed British retail spending plunged by nearly a fifth and broader measure of consumer spending fell by more than a third in April. It's now very hard to imagine a rapid V-shaped recovery, and we don't expect a return to pre-virus levels of activity until 2022 at the earliest, said James Smith, developed markets economist at ING. The risk now is that a wider proportion of firms are beginning to make more permanent changes to their business models. Now the potential longevity of the crisis is becoming clearer. After rallying in April on a raft of global stimulus, investor sentiment has soured this month on the double whammy from fears of a second wave of COVID-19 cases and rising US-China tensions. Britain's death toll from the respiratory disease now exceeds 40,000 and is by far the worst yet reported in Europe, an ominous sign as the government starts to reopen an economy crippled by the lockdown measures. In the latest sign of the corporate hit from the pandemic, Aston Martin slumped 16% to the bottom of the FTSE 250 after posting a first quarter pre-tax loss as sales dropped by nearly a third. Oil and gas producer Premier Oil rose 2.6% after saying it expects to be free cash flow neutral despite slumping prices due to its hedging program. Stock Spirits jumped 17.5% after posting a jump in first half earnings as consumers stocked up on liquor ahead of tax hikes in its biggest markets, Poland and Czech Republic. Doesn't say this in the article, but we're not surprised people are turning to more drink. End of article. The situation is undoubtedly grave, which despite a slightly stronger US dollar, with the dollar index now at 100.2, gold has benefited, though silver's taken a 4-cent hit to $15.49. Gold, however, is currently up $7 at $1,711, or up £12 at £1,400. The good news for gold, however, is that price premiums between New York and London have fallen dramatically, as we said they would. And ironically, one of the major victims of such a disparity has been HSBC Bank. Let's take a quick look at a Bloomberg article on this very subject, highlighting why HSBC has recently lost more than $200 million. Bloomberg article dated May 13th, 2020. HSBC lost about $200 million in one day on gold market turmoil. HSBC Holdings plc lost around $200 million in one day in March because of disruptions to the gold market that caused prices to diverge dramatically in key trading hubs, according to a filing by the bank. The one-day loss was unusually large for a market in which the leading banks, which include HSBC and JP Morgan Chase & Co., typically hope to make around $200 million in an entire year. It far exceeded the maximum loss anticipated by HSBC's value at risk models. HSBC's loss highlights the extreme nature of the disruption of the gold market in late March as lockdowns closed refineries and grounded planes, strangling the supply routes that allow physical bullion to move around the globe. The price of gold futures in New York and spot gold in London, which usually trade within a few dollars an ounce of one another, diverged by as much as $70, the most in 4 decades. The divergence hit banks that are active in trading the so-called EFP, or Exchange for Physical, the mechanism by which traders switch positions between the New York and London markets. HSBC, which had disclosed in a previous filing that it was hit by the gold market disruption, revealed the scale of the loss in a chart this week, showing its daily trading profits for the first quarter. The bank described the loss as a mark-to-market loss mainly associated with gold refining and transportation challenges. It highlighted the unprecedented widening of the gold exchange for physical basis, which affected HSBC's gold leasing and financing business and other gold hedging activity, leading to market-to-market losses. HSBC declined to comment. In the past week, the price difference between the New York and London markets has returned to more normal levels of less than $5 an ounce. So we're laughing, but we said this would happen. Still, HSBC is not the only one struggling with the unusual moves in the gold market. Banks often sell gold futures in New York to hedge their positions in the London market, exposing them to significant losses should the two markets diverge. As a result, some banks have stepped back from trading the EFP in recent weeks, and Canada's Bank of Nova Scotia, for years one of the leading bullion traders with a business that dates back to the 17th century, told staff in April it was shuttering its precious metals unit. End of article. So, with gold markets starting to return back to normal, and futures and physical premiums falling, those who are somewhat light in their gold portfolio can be reasonably confident that taking a 2 to 3 year view, current prices are still relatively cheap. We are expecting tensions with China to increase. And as the Trump administration finds itself in a situation that the after effects of this crisis will be much longer lasting than originally envisaged, people to blame will inevitably rise to the top of the political agenda, especially in an election year. Why does House of Cards spring to mind? The perfect storm is beginning to brew, and we had all better ensure we are prepared for it. What do you think? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they're published. Not forgetting we update our Richard and Greg channel every few days, and there will be a new update on that channel tomorrow. We hope you have found this video interesting and informative. And if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.